Good morning, good afternoon, good evening, depending where you are on the planet, and welcome to the TGI Friday. Thank God it's Friday. Bull versus Bear webinar. Steve Muddy on the call here for TradeDay.com. Welcome, everyone. Going to go for our usual regular run through in here. Calendar, what we've had, what we've got coming up, macroeconomic fundamental events, what's impacting markets right here, right now, and a quick look at the charts. So, where are we? Wall Street closes green as GDP data eases recession worries. Now, I'm not sure if I said it to you. I do a few webinars and speak to various people during the day, so I kind of forget who I say to who. But yesterday, when I was talking to some people, I mentioned the fact that usually GDP data, so just going back to yesterday, doesn't really move markets too much. Okay, well, it did move markets yesterday, certainly. It's a bit of a slow burner, but I'm sure it was behind the rally that we saw into once we got the choppiness after the open. So the data was released. The market only went marginally higher on the open, obviously chopped lower, chopped back higher, and then it was a steady rally through the day. But you see in here the significant beats really. So it is the preliminary data. So the preliminary data is usually a bit more important than the final data. Final data is just adjustments, but the preliminary data, significant beat in here. Expected 2.6 coming in at 3.9. And then the other thing to note in here, the PCE data in here. Have they got the PCE data on here? I don't know if it's got it on, and I didn't have it on here, did it? So the PC, oh, it is there. It's PCE prices, yeah. Look, expected previous at 4.7, expected at 4, came in at 3.9. Now there was another piece of PCE data I saw. I thought it was on another calendar. Let me quickly open up the FX Street calendar and see if that makes any difference. FX Street economic calendar in here. Sorry, I just want to make sure. So if we go, so we've got the rest of it. Oh, I hate it when it does that. Sorry, guys. Oh, where's the FX Street calendar? Okay. We'll get there in a second. I promise you. The point I'm trying to make in here basically is the data came in better than expected and the market kind of went up. But I do want to point out though, just going back to yesterday's data in here. So it goes Thursday through Friday. Okay. So yeah, they've got it on here. So PC data. So not only we also had the durable goods orders as well. Big beat on durable goods orders as well, okay? But there's the PCE data. 5.3 expected. Oh, here we go. So previous 4.7, consensus 5.3, came in at 3.9. Is that what the investing calendar is showing us on here? 4.7, 3.9, yeah. So they've got forecast at 4% in here. So that was very different on the FX Street calendar. The forecast here was 5.3, okay. Came in at 3.9 though. And obviously this is the inflation measure, right? And the Fed tell us that's part of their inflation measure. So what we certainly saw in here yesterday was all the data was pointing the right way. Yeah, we had GDP beat, okay. We had durable goods had a massive beat. If we can see in here this 5.6 number, if I click in, does this show the chart? Yeah, they do show the chart here as well. Look. So the number came in at 5.6. It was a massive beat. It was the biggest number we've had in here since all the way back here since, where are we? This is like the rebound after, so that's the collapse in durable goods as COVID broke in April, May. And then that's the recovery. It's in 2020, June, July, August, okay? So COVID, so that's a COVID blip, right? We came in at 5.6, yeah? It's up here, look. Outside of the COVID numbers, we haven't seen that since, what's the number back here? 4.6, it beat that. Yeah, so let's see max where we go on the max. It was the biggest number. I'm surprised this is not grabbing the headlines more. The biggest number since 2017, 6.4, 2017. So it's a big number on durable goods. Okay, so durable goods very very positive. GDP positive, and the PCE data as well. Okay, PCE data in here showing slowing inflation. So all of that pointing in the right direction, right? It's telling us the Fed rate hikes are slowing the inflationary pressures down without having a significantly big damage to the economy. Okay, so we could easily see that soft landing that we've all been hoping for. And to be quite honest, at the end of last year, I just didn't think they'd be able to quite pull it off. I think we'll at least go into a small recession. I've been saying since all through last year they were hiking. Likely, when you have inflation running like this, the aggressiveness of their interest rate hikes from having been decades at near zero, it's going to significantly impact the economy, right? So you expect a significant slowdown, and it would have been a surprise to go into a recession. So recessions are all part of the whole boom bust cycle that we've continuously been in. So I did expect us to go into at least a mild recession certainly in many nations, and potentially the US was better situated. But it looks like not only as, and I've been saying this now for a few weeks, it looks like Europe, UK, which are in a worse scenario, given the heightened inflationary pressures coming from the fact that we do have a war raging on our doorstep, and um, energy prices are significantly higher in Europe than they are, say, in the US, and there's all those supply constraints with that. So yeah, I mean, all the data pointing the right way. So it's no surprise to me that the market ended up, going from this data. And as I say, GDP is not usually a big mover in markets, but yesterday it certainly was. Certainly was. So PC is definitely going to be important today. We've got it in less than an hour. Okay, this is the month on year on year. We had the quarter on quarter data yesterday. Remember, the Fed tell us, even though it never moves the market as much as CPI, okay, the Fed tell us it is their preferred measure of inflation. So then we should certainly be paying attention to it. And don't forget also, so that's in just under an hour. Then at 10 o'clock Eastern, right? We have Michigan consumer sentiment. This does move markets sometimes, okay, and it's often overlooked. It always comes out on a Friday. It's always the later the piece of data tucked away at 10 o'clock. People often forget it's there. Don't forget it's there. 10 o'clock, it can have an impact. It does often move the market. So watching out for that as well. Okay, earnings side, looking back at yesterday, first of all, we had disappointment after the bell. We covered a lot of this already yesterday. But after the bell, Intel missed, and they were quite significantly negative. Okay, so not sure where it go. So here Intel delivers one of its gloomiest quarterly forecasts. Okay, very, very, very negative from Intel. Yeah, and that's like the big part of the. It's obviously a significant company in the US. It echoes the semiconductor industry and the personal computing industry. So it's a big part of the US and global economy from Intel. But it hasn't significantly. Yes, we're slightly lower. But we're stock indices are slightly lower, being dragged slightly lower this morning, but not significantly given the gains that we saw yesterday. Looking into today on the earnings side, it's fairly cut. We've already had the kickoff of the oil, so we're going into kind of, generally speaking, we get like financials, then we get conglomerates, and we start off on tech, and then we go into oil. We've got a lot of tech next week, and I'll jump just very quickly to that in a second. But we've gone into oil. We had, I think, was it ExxonMobil we had yesterday? No, maybe the day before. I'm not sure. But anyway, today we certainly have Chevron, and we've had Chevron. And Chevron, big numbers. Okay, they actually beat on the revenue, missed on the EPS, but nevertheless, in here, article here, Chevron annual profit doubles Chevron annual profit doubles to record, but still misses estimates. Okay, but still very, very, very healthy numbers nevertheless. Let's dip into 5 things to start your day. So Chip Alliance, this is basically talking about the fact that Japan and Netherlands joining the US in limiting China's access to semiconductor authority. That's not positive for markets, right? It's kind of a mini kind of part of like a trade war. Okay, so that's not a positive. Intel shares plunged down 11% in post and pre-market. Okay, so certainly that was very negative. Just talking about the invasion, we know that we're a year in now, nearly a year into invasion, and so that's nothing really impacting us. No, that's not actually any new news in there. And S&P dipping on that, probably on that Intel, and a bit of something else I want to talk about. They're not got it on here though, but Adani as well. So I didn't think, I covered this over the last couple of days in here. Where are we? So stocks gains fizzle, Intel, PC core deflator is next inflation data point. That's today. Okay, so we're watching that today. Where are these articles? So we basically had Adani plunging lower in here, short sellers in here, pointing to it as being significantly overvalued, tumbled 20%, smashed the Nifty 50, which is the Indian stock exchange, taking it down to a 3-month low. I'm not saying this has a significant impact into the US markets, okay? But nevertheless, the fact that the Asia's richest man, one of the richest men in the world, has been hit by the short seller Hindenburg research in here, and certainly highlights ongoing frailties to maybe markets, and then also echoes in here the fact, it probably has had a slight impact on the indices overnight in here. A few other kind of more like bigger picture articles in here that I have, so not that one, this one. Global equity funds attract inflows for a 3rd week in a row. Okay, so 3 weeks now in a row, global equity funds getting inflows. Okay, so that's obviously as the market looks more stable in its recovery, and the bottom looks like it's probably in the bottom. Actually, we called in October, back after the day after that CPI data back in October, and markets looking a lot more stable now going forward. So no surprises that equity inflows are coming. And a little piece in here: Fed sees soft landing as silver lining. Brainard Wallace site drop in making case for soft landing. Yeah, so it looks that way. It looks like we could be seeing a soft landing, i.e., no recession. And then this is about Hindenburg and the Adani short selling. Bill Ackman in here throwing his weight behind that. And then looking into today, so we've had a slight uptick in European equity indices, not much in here. Probably most of that on the back of, remember, we close earlier than the US closes. So this is them playing a little bit of catch up on the late session rally that we saw in the US into the close. And then if we look in here this morning, we're kind of just dipping in. NASDAQ leading us down, having us led us up. But, S&P and S&P's only down a tenth. Dow's pretty much unchanged, 0.4 lower, but having added in about 1.5% on the NASDAQ to the upside yesterday. Okay, roller coaster. Let me have a quick look at the CME tool in here. Nothing changed in February, pretty much nailed on for a 25. March, this is growing now. This has been continuously growing in here, the March number. And if I go and show that on the historical, before I go to the historical, let's go and look in here. And then staying pretty much from March at this 475,500, staying there, 475,500 as the peak. Okay, right the way through the summer. And then when we hit November, 450, 475 rate cut, 425. Well, actually, just 450, 475. So maybe 2 rate cuts. Certainly one potential chance of us being back where we are now. If we go back to the March in here, the probability now increasing for 225s, and that being the peak. If we go to the historical, so what did I say? We're going up to 4. We're at. Sorry, let me go back to that. 475, 500, right? Gosh. Old age. They need to sort this out that you can just deselect all. Would be more helpful, wouldn't it? If we could deselect all. I haven't seen. Let me see this drop down in here. No, I didn't think so. I think I've looked at that before. So 470. So look, we're basically getting back up to peak that we saw. When was that? On the 23rd. So the beginning of this week, we saw a peak up there at 87.5%, and we're nudging back up towards that. So pretty much nailing on in here. The fact that we're going to get the highest probability, pretty much we're going back to that highest probability for the March meeting that we are going to be at that we're going to have 225s, and that's going to be potentially be it. Okay, let's go take a look at the charts. Kick off in the S&P. So dipping a rebound, we said 2 days ago. Yesterday, another new high. Got close to my target area. Remember, we had this target area where the 76, we had this old peak, this little failure peak in here after the spike higher. That was the CPI data up there, remember? Okay, and then we had the day after the CPI data, the rebound peak there was at 40.90 and 3/4, and then we've got the retracements to 76.4 and 78.6, 40.93 to like basically 40.97. Easily in range going into today. I wouldn't be pretty surprised to see, obviously, dependent on the data, the PCE data that we have coming up in under just about 45 minutes now, a challenge up to these levels in here. So maybe hitting back up through 41, getting a 41 handle on this going into the end of the week. Bit of FOMO coming in, I think. If we step into the 15-minute chart, it's been, we've dipped, but it's hardly a dip, right? It's kind of sideways. There's the initial move on the data was higher, and then the market was lower through the open yesterday, and then a strong rally throughout the the late morning and afternoon sessions into the close, and closed pretty much bang up on the highs. And it's just been a drift since then. And there's no obvious trigger points on the top side, really. It's just up through the high or up through the bar that we've just been on, the latest bar, 40.70 1/4. Or 40.77. There's no obvious trigger points in here, and there's no counter trend line. Really, I wouldn't say below the recent low. I think it's all the way down here, until it starts to look a little bit more negative. 40.43. That's quite a long way down. You could say you got a little low in there actually, ahead of there. 40.52 1/2. And then 40.43, little levels on the downside. NASDAQ, similar story. Okay. We'd already gone into this resistance area here, took out this peak in here yesterday, just got above there. Could be up at the highs, could be all the way up at the highs. Probably not, but getting maybe close. So the high there, 12,339. Okay, can we see 12,300, 12,250 today? Certainly, possibly. Yeah. So definitely still looking for upside there going into the day. Let's have a look at the trigger points. So yeah, I mean, just a buck above the last bar in here, the 15-minute high, 12,072, and then you got the actual high at 12,113. On the downside is probably below. Yeah, I mean, just below the actual overnight lows. You've got 12,013, so down through 12,000 looks more negative, and then you've got another little trigger point here, 11,970. Okay, the two levels I've been watching on the downside. Okay, what else we got? Bonds, let's start there as I'm on there. It's kind of been choppy sideways, but now choppy sideways down. We did take out the low there. We're sitting not much above this swing low here. Certainly down through there, it looks a lot more negative. So 114.09 and a half. So yeah, I mean, I'd probably be looking more bearish. It looks like more of a topping pattern in here now. Yeah. So look, it's taken out that low. Down through here, it certainly looks, yeah, a lot more negative in here. So 14.09 and a half. Triggering maybe a short down through there. Saying any rebounds, looking at the counter trend line here, selling rebounds towards that up in the 14, 17, 18 area for treasuries. That's 10 years. Sorry, 10 years. Let's look at oil before gold. So oil back up towards the highs. We did have this dip a couple of days ago. Decent rebound yesterday, sitting near the highs. Fully, see a risk to the highs. And if we take out the highs, and then you've got the highs over here. So we ran through these the other day. 82.64. 82.66, this spike high here, 82.71, and then 83.14. I mean, if through that 82.65-75 area, quickly opens up 83.14, and you could easily see this up to like $83.5, $84 in here today, particularly if we get a bid on the stock indices. Gold dip, and remember we've only seen I've seen 3 days down here, 2 days mostly, 2 days, 2 days, 2 days, and then rebounds, 2 days, 2 days, 3 days down, we're into like a first day and maybe a second day down in here. It's kind of holding all these supports from this week, the Wednesday, the Monday, Tuesday, Wednesday lows in here. We've got a string of supports from like 1918 to 1910. It's kind of just rebounded off of that. Not only yesterday, 1918.4 this morning, 1919.8. I'm hanging on to bullishness in here. Now, if it does take out these lows, and particularly you've got a low over here, if it takes out this low here, 1918.2, it looks a lot more negative, but I'm hanging on to a bullishness, and particularly as we've gone back above in here. I probably can just redraw this one if it will allow me. Will it do that? Yeah. See, look, we've gone back above this one in here. Oh, it didn't like that, did it? Sorry. Why does it do that to me? Okay, there we go. So we're already through that. It's an important trend line. Why is it an important trend line? Because we've got like the mythical third touch, right? So draw off of here, touches here, slight breach, fails. Then you get a higher low. That's important as well. Higher low here. And this low here was in respect to this low here. So the market's clearly respecting this like 19, 18 and a half, 18 area. Rebounding through there. We're getting a dip in here at the moment. Probably looking to buy this next swing up. Okay, so yeah, gold staying bullish. So bullish gold, bullish oil, bullish stocks, tentatively bearish in here on the treasuries. Any questions? No questions. All right, guys, thanks for coming on. I'll be back with you on Monday. Have a great trading day. Have a great weekend. Until then, take care even and stay safe. And I'll speak to you again on the Bull versus Bear webinar on Monday. Have a good one, guys.